Most men lose not because the market defeats them, but because they defeat themselves by choosing the wrong battlefield. Time frames are that battlefield. I learned early, and then learned again the hard way, that a trader can have the right idea, the right market, even the right instinct, and still lose money simply because he is fighting on the wrong scale. The market does not punish ignorance alone, it punishes confusion, and nothing creates confusion faster than misunderstanding time. Every chart tells the truth, but not the whole truth. That is the first trap. A man looks at a 5-minute chart and believes he is seeing reality. He is not. He is seeing a fragment, magnified and distorted by urgency. Another man studies the weekly and believes it guarantees success. It does not. Time frames are not enemies, but they become traps the moment you use them without hierarchy. A trader who treats all time frames as equal is like a general who listens to every soldier shouting orders at once. There can be no command, only noise. I once believed that speed was intelligence. I believed that if I could read the smallest movements, I could outmaneuver the crowd. That belief cost me more than any single bad trade. The lower the time frame, the more frequently you are forced to decide, and every decision carries the weight of emotion. Fear does not wait patiently. It thrives on immediacy. Greed grows loud when price flickers upward. On small charts, these emotions are fed constantly. That is why so many traders feel exhausted before noon and reckless by afternoon. One of the most common traps is mixing time frames without knowing it. A trader sees a bullish weekly trend and buys confidently, only to panic sell when a 15-minute pullback appears. He tells himself he is managing risk, but he is lying. He entered as an investor and exited as a gambler. The market did not change. Only his frame of reference did. This is how accounts are slowly bled dry, not by disaster, but by contradiction. You must decide what kind of trader you are before you decide where to enter. If your thesis is built on the daily chart, then the daily chart must also tell you when you are wrong. Anything smaller is execution noise. If you allow a lower time frame to overrule a higher one, you surrender authority to the least reliable voice in the room. The market respects structure, not impatience. Another trap lies in the illusion of precision. Traders are drawn to small time frames because they believe tighter stops mean lower risk. This is a dangerous misunderstanding. A tight stop placed in a chaotic environment is not protection. It is an invitation to be removed. Markets breathe. They expand and contract. On lower time frames, that breathing looks violent. Stops are hunted not by intention, but by randomness. When you trade too small a frame, you are fighting the natural movement of price itself. I have seen men take 10 losses in a day and call it discipline because each loss was small. That is not discipline, that is attrition. Discipline is choosing a battlefield where your odds improve, not merely surviving repeated skirmishes. The higher the time frame, the clearer the battlefield. Levels matter. Trends have meaning. False signals diminish. Your stop may be wider, but your reason for being in the trade is firmer. There is also the trap of overconfidence in the higher time frame. Some traders discover the power of the weekly or daily and believe it absolves them from timing. They enter carelessly, far from structure, and justify it by saying they are long-term. That is laziness disguised as wisdom. Higher time frames provide direction, not immunity. Even a strong trend can punish poor entry. Patience must be applied twice. Once to wait for the setup, and again to wait for the market to come to your price. Many mistakes come from impatience, masquerading as opportunity. A trader watches a market move without him and feels excluded, as though profit were a train leaving the station forever. He drops down to a lower time frame to chase an entry, telling himself he is being tactical. More often, he is being emotional. Markets offer endless opportunity, but only to those who are willing to miss some of them. The need to always be involved is a disease, not a strategy. One of my costliest habits was the constant adjustment of perspective. I would enter on a daily signal, then manage on an hourly chart, then exit based on a 5-minute scare. Each shift felt justified in the moment. Each one weakened my position. Consistency of thought is more important than cleverness. When you change the lens mid-trade, you change the rules after the game has begun. The market does not reward clever men. It rewards consistent men. A trader who knows exactly which time frame governs his decisions sleeps better than one who watches every tick. Sleep, I learned, is a trading advantage. Fatigue blurs judgment. Lower time frames demand constant vigilance. Higher time frames demand trust. Trust is harder, but it is cheaper. Another subtle trap is using indicators without regard to time frame context. An oscillator that works beautifully on a daily chart becomes a liar on a 5-minute chart. Signals multiply, but meaning evaporates. Traders blame the indicator, but the fault lies in misuse. Tools must match the scale of intent. A hammer is not defective because it cannot sew. There is also the trap of hindsight. After a move completes, every time frame lines up perfectly. Traders convince themselves they could have captured it all if only they had acted sooner. This fantasy drives them back into lower frames, hunting perfection. The market does not offer perfection. It offers enough. A trader who is content with enough survives. One who demands all is eventually taught humility. I have learned that the market is most dangerous when it feels most familiar. After a series of wins on a certain time frame, confidence turns into complacency. Rules soften. Stops are widened or ignored. Time frame discipline erodes quietly. Then comes the loss that erases weeks of effort. This is not bad luck. It is the bill coming due. To avoid these traps, a trader must build a simple hierarchy. Decide first where the primary trend lives. For most, this is the daily or weekly. Let that chart answer only one question: direction. Then choose a secondary time frame for structure and entry. Nothing smaller should influence the decision unless it was part of the plan from the beginning. Planning after the fact is surrender. You must also accept boredom as a cost of doing business. The higher the time frame, the longer the waiting. Most traders would rather lose money than be bored. That truth explains most market behavior. The man who can sit quietly while others fidget has already separated himself from the crowd. I do not claim to have mastered this easily. I paid for these lessons with years of profit and loss statements that told the same story again and again. My best periods came when my approach was simple, my time frames aligned, and my activity restrained. My worst periods came when I tried to outsmart time itself. Time frames are not just charts, they are reflections of human behavior. Short frames reveal fear and greed in their rawest form. Long frames reveal conviction, accumulation, distribution. When you choose a time frame, you choose which emotions you will battle. Choose wisely. The greatest freedom a trader can achieve is freedom from reaction. Higher time frame clarity grants that freedom. You no longer jump at every sound. You wait for the signal that matters, and when it comes, you act without hesitation because you have already done the thinking. In the end, avoiding time frame traps is not about finding the perfect chart. It is about aligning your temperament with your method. A nervous man has no business trading small frames. An impatient man should not pretend to be long-term. The market exposes dishonesty quickly. If you remember nothing else, remember this: confusion costs more than being wrong. Pick your time frame. Respect it. Let it govern your decisions from entry to exit. Do not argue with it. Do not abandon it under pressure. The market will test you, but it will also reveal its intentions to the trader who listens from the proper distance. Time does not rush. Neither should you.